Stocks have gotten so beaten down that they're being taken private left and right. The market might not have any interest, but private equity firms see the value here. They can't seem to resist. Now, we got the latest deal on Monday morning when a private equity firm called Vista Equity Partners announced an $8.4 billion deal to acquire an outfit you probably never heard of, called Avalara, which makes tax compliance automation software. Now, look, I cannot think of anything more boring as a business, but this deal is very exciting for the industry because it's the latest in a series of publicly traded software companies that have been snapped up by private equity buyers. Now, tonight I want to walk you through these because it's such an important element of this market. These acquisitions demonstrate that the software stocks have finally gotten cheap enough to be interesting again, and that's what I've been waiting for. Ever since the Fed declared war on inflation last November, I've been warning you away from fast-growing software plays with little or nothing in the way of profits. And you know what? Their stocks have been absolutely gutted because Wall Street has no idea how to value them in this environment. But private equity firms, they're different. They buy entire companies, take them private, spend a few years cutting costs, then bring them public again, ideally at a much higher price, and that often happens. See, they don't have to care about the Wall Street fashion show, except insofar as it creates long-term buying opportunities. And they won't be stopped by the antitrust department of the antitrust division of Justice Department, because that only happens when private companies try to block somebody from making money, or more importantly, when two public companies that compete are merging, and then justice gets active. Now, I want you to take the most recent deal, and you'll understand what I'm saying. Avalara, that had 40% revenue growth last year, along with a small earnings loss. This thing came public 4 years ago at $24, then saw its stock soar during the COVID year, flying all the way to $191 at its peak last November. But since the Fed turned hostile, the stock has been crushed, sinking to the 60s at its lows in June. However, we started hearing about private equity interest a month ago, which allowed Avalara to rally from the low 70s to the mid 90s. So in other words, Avalara, you have to understand, it looks like it wasn't a big deal when it was announced, but the stock had already run. So when we learned Vista Equity was buying it for $93.50, that was actually a couple bucks below where the stock was trading, but only because the stock had already run on takeover rumors. So don't make it feel like it's take under. What matters though is that Vista's valuing Avalara at about 10 times sales. That's the level where they found this one too enticing to ignore. It's not a bad price at all. It was just down big from the highs of last year. Now, this is not the only big deal we've seen from Vista. See, back in January, they teamed up with the activist investors, who we think are really smart, at a place called Elliott Management, and announced the acquisition of Citrix Systems. That's the original remote work software play. Vista's taking this thing private and merging it with another software company they bought years ago that I was also recommending, called TIPCO. They're paying $104 per share, or $16.5 billion for Citrix. A big deal. Now, this is a more mature, slower growing company than Avalara, and more importantly, Citrix is quite profitable. So the story's a little different, but this stock jumped from $110 at the end of 2019 to a high of $173 in the summer of 2020, before pulling back to the high 70s at its lows last December. In terms of valuation, at $104 per share, they're paying roughly 5 times sales for Citrix, or a little less than 20 times earnings, which is far more relevant. As you can see, what they're paying. This is important because we're trying to show you graphically how inexpensive some of these are coming at. All right, then there's Thoma. That's another private equity firm that's been spending a fortune on software companies of late, taking them private left and right. Last Wednesday, they announced the deal to acquire Ping Identity. Remember Ping? They used to come on the show for $28.50 per share. It was an all-cash deal that values the company at $2.8 billion. This is a company that does cybersecurity for firm. I'd say it's a very niche cybersecurity company. Handles identity management. You know what it's similar to? It's similar to Okta. You know we have them all the time. Ping grew at a 23% clip last year, and they turned a slight profit too, although they're expected to lose money for the next couple of years. That's the kind of stock that you didn't want to own until this big sprees started occurring. Now, this one is a huge deal because Thoma is paying a 63% premium for Ping. That is very generous. Deal values the company at about 8.4 times sales. This is actually the third major cybersecurity company that Thoma has acquired in the last 15 months. In April, they announced a deal to buy SailPoint Technologies. That's a terrific company. It's another identity management play. That was a 48% premium to where the stock had been trading. That was in the previous 9 days. This one's getting valued at 13 times sales. Before that, last year, Thoma spent $12.3 billion to buy one of our favorites, Proofpoint. which mostly protects against threats via email. In a deal that closed last August, Proofpoint ended up valuing it at 10 times sales. That was a steal. I'm betting Thoma Bravo intends to combine these cybersecurity businesses into a single outfit that they can cross-sell, cut costs, then take the whole thing public yet in a gigantic hit for them when Wall Street has a taste for tech. It's if that's what they're doing, I can tell you, this is a brilliant plan. And that's just cybersecurity. In March, Thoma Bravo agreed to sell